Welcome back. It's been another action-packed week in the market, but thankfully no tariff news because it seems like all we've been talking about recently is tariffs. But what we did get this week was Nvidia news. The Nvidia GTC Conference was on the 18th, and as you can see, the overall reception, at least in terms of stock price, wasn't great. The stock was down almost 2% on the 18th, and it ended the week pretty much flat. This Nvidia GTC conference is this AI conference, and based on the Nvidia GTC page here, GTC is happening this week and it's bigger and better than ever. Connect with thousands of developers, innovators, and business leaders to experience how AI and accelerated computing are helping humanity solve our most complex challenges. So essentially, it's a conference where innovators and engineers gather and they talk about the newest tech and what's happening with AI and accelerated computing, as they said here. And overall, it's hard to walk away from this conference not excited about the future of AI and autonomous this and that and robotics and all of that. But I'm not going to dive too deep into what was said at the conference. If you want to watch the conference, you can go to NVIDIA's website and watch it. I'll dive a little bit into the lineup of GPUs and CPUs and their data center products, just in case you haven't seen it. But then we're going to watch this CNBC video just to get a sense for how investors are feeling about the conference and what this means for revenues and earnings and, how this could affect the stock price. Next, we'll move into the news we received on Wednesday, where the Fed essentially decided to hold interest rates steady. So we'll take a look at what their decision was, what this means for markets and our stocks moving forward, and any other important details mentioned in that event. Then we had one of the companies that I personally own report earnings on Thursday, and spoiler, they beat on both revenue and EPS. However, the stock was down almost 9% this morning. So we'll talk about, the results, why the stock is down, and what I'm doing with my shares, if I'm buying more, if I'm selling them, and what I'm expecting for the future of this company. We also got news that Celsius, another company that I hold, named this Eric Hansen guy as president and COO of the company. We'll talk about why that can be super beneficial for Celsius moving forward. We also got news that Sofi sealed this $5 billion deal with Blue Owl Capital, so we'll take a look at that deal, what it could mean for the company, and all of that. And then lastly, we'll take a look at what I personally bought in my portfolio this week. It was a pretty good week. We were up almost or over 4%. So stick around to the end to see my buys. So let's jump right in, starting with the Nvidia GTC conference. I wanted to show you their product lineup that they displayed or showed during the conference. So in 24, we got the Blackwell GPU. In 25, we're getting the Blackwell Ultra GPU. Then they announced the new Rubin GPU, which, everyone's been talking about essentially. In 26, we'll also get the Vera CPU, a new CPU. And then in 27, the Rubin Ultra GPU. And of course, all this technology is better and greater and faster and all that. But as I said, the stock was down on the day and pretty much flat during the week. So let's see what these investors have to say about the Nvidia GTC conference.
Down 3.5%. I guess they didn't answer that question. They did not answer that question in 2 hours. This is not granted for investors. This is not a meeting for investors. But still, that is what has been dogging the stock.
Not a meeting for investors, but every investor is focused on the meeting. So it is a meeting for investors, and I think you're right. Look, Rubin looks like it's a second half 26 story. I think market probably knew that, number one. Margins didn't come up. Robotics, multi-trillion-dollar industry potentially. So he said all the things about the future and that are exciting, but I don't think anything that's been concerning investors or traders, I don't think any of those concerns were assuaged. And I continue to think that they might talk about a reacceleration of margins in the second half. I just don't see it happening. So this move actually makes sense to me.
Yeah, and this was not a scripted speech, my understanding. So this is a kind of a free-flowing dynamic. And to the extent that you could have just gotten a little bit more into where the new use cases, in other words, moving away from data centers, moving into, there's talk about collaboration with GM on AI, et cetera, et cetera. So the $1 trillion addressable market isn't really new. I think if you look at the stock, from that Jan 7th, at least recent high, it's been making lower lows. So, we're going to talk about some of the other big mega cap tech stocks, but there's nothing on the charts that tell you that this company is in a safe spot. And semis, continue to look like they're vulnerable.
Is Tim playing hurt here, guy?
Well, that tie would suggest he's playing something. I mean, what is that?
Maybe it's the voice or
Does it
something?
get wider? Is it,
Melissa told me she loves this tie.
Mel, is
She'd
he a
like me to
little-
wear it more often.
is he a little
she's
hoarse?
laughing, as if that's not what
say
she said.
nay.
Nay.
The fever's broken in this trade. Like, let's just be clear here, right? So if this happened a year ago, whatever he said here, with those throngs of people there who were really excited, the stock probably would have been up 5%. We were looking through the options market. The implied move between today, this morning, and Friday's close was about 6% in either direction. Just think about that, okay? So when you think about what's going on here, the expectations, I didn't think they were going to be particularly high. The company just reported a few weeks ago. They obviously didn't say any real big news for this sort of event, and they probably knew that. The one thing I'll just say is, like, lots of headlines. When Guy talks about margins not going up in the second half of this year, the information has an article out this morning that Amazon Web Services, they're offering their own chip to cloud customers, same performance as the H100 from Nvidia, but at 25% of the price. This is how any other semi company who's coming into the space, they're going to compete on price, especially if they have the same performance as the last gen sort of chips. So to me, listen, the story's great, okay? They're expected to grow earnings and sales this year 50%, trades at 25 times. Next year, it's supposed to grow 25%, expected, trades at 20 times. So if you're a valuation person and you believe what they're saying, then the stock is cheap here. But if you think that the fever's broken all around, if you think that the economy is going to get weaker, if you think their major customers are going to pull back in their CapEx at some point or diversify away from a single source, then the story is not that attractive right here.
So it doesn't really matter what Jensen Huang says. I mean, to play the role of Ms. Silver Linings on this test, and somebody else is not doing that tonight.
Sorry, I missed that.
The fact that there is no new guidance after 3 weeks after reporting earnings, maybe that is a good thing, considering how we have seen confidence drop off a cliff in so many other industries. For him to stick by that forecast, that wasn't enough still.
No, I think you make a good point, right? They have every opportunity to back away. The economy is slowing. Maybe CapEx is not going to be as robust. I think you're right to point it out. But I also think the market's trying to get in front of a potential slowdown and the potential for CapEx not to be as robust as things, as many of these stocks have priced in. I think that's sort of the rub right now.
So there's a lot to unpack there. First of all, as I said at the start of the video, walking away from this conference and not being excited about the future of AI and robotics and autonomous this and that, impossible for me. However, I invest in AMD instead of Nvidia, which is seen as a competitor. And that's largely because Nvidia has already had its run and a lot is already priced into the stock at this point. And as I mentioned in the video, Amazon launching their own in-house chips for 25% of the price of H100s. And AMD might soon release their own chips that could compete with Nvidia chips. We'll have to wait and see. But regardless of all that, if we look at their valuation here, a forward PE of 26 and a 2-year forward PE of 26. So the valuation seems very reasonable here. But the reason I'm not personally invested in this company is because of the potential competition. And as I said, the company's just made its run at this point. So forward PE, as you know, is based on future estimated earnings. So what analysts are expecting for earnings the next year and based on 2026 numbers, if you look at the 2-year forward PE. So yeah, it might seem pretty low for a company like Nvidia. However, look at this. If we go down to the ratios, if we look at the gross margins of, anywhere between 70 and 80%, it's incredibly high. And the profit margins close to, 55, 56%. It's also really high. And you can see it's much higher compared to, previous years. But essentially what could happen if companies decide to move away from Nvidia or go with competitors, we could see Nvidia having to lower the prices of their products. And therefore, these profit margins are probably going to drop down to, I'm not going to make an estimate on where they're going to drop to, but if their profit margins drop, their earnings aren't going to be as good. So that could end up making the company not as cheap as it appears to be today. But does that mean that I think the company is going to crash 50%? No. I probably think there's money to be made in Nvidia. I'm very excited about the future of AI and robotics for the next, 5-10 years. And I think Nvidia are going to control most of that market like they do today. But personally, I just see AMD as a better opportunity. You have Nvidia with their revenue growth, their earnings growth, their gross margins and profit margin probably all declining in the next couple of years, while AMD is just accelerating their revenue growth, earnings growth. And for short-term gains, being in a stock with accelerating growth and margins, that's where you want to be. And with AMD, the expectations are already so low. So any positive news is likely just going to bring the stock price up. Moving on to the Federal Reserve news, this article here says that Fed holds interest rates steady, still sees 2 cuts coming this year. The article goes on to say, faced with pressing concerns over the impact tariffs will have on a slowing economy, the rate-setting Federal Open Market Committee kept its key borrowing rate targeted in a range between 4.25% and 4.5%, where it has been since December. Markets had been pricing in virtually zero chance of a move at this week's 2-day policy meeting. So essentially what they're saying is, based on the price movement of the market, investors were not expecting a rate cut this time. And as we know, investors want rate cuts so both individuals and companies can borrow for less and spend more in the economy, and therefore grow earnings and revenues of all the companies that we own. But they continue by saying, despite the uncertain impact of President Donald Trump's tariffs, as well as an ambitious fiscal policy of tax breaks and deregulation, officials said they still see another 0.5 percentage point of rate cuts through 2025. The Fed prefers to move in 0.25 percentage point increments, so that would mean 2 reductions this year. So to put it simply, they're essentially just waiting and seeing. They talk about increased uncertainty, so therefore they're just waiting to see how things play out in the actual data and in the numbers before making any further decisions on lowering or raising interest rates. However, the most interesting and most important part of this meeting was this: scaling back quantitative tightening. In addition to the rate decision, the Fed announced a further scaling back of its quantitative tightening program, in which it is slowly reducing the bonds it holds on its balance sheet. The central bank now will allow just $5 billion in maturing proceeds from treasuries to roll off each month, down from $25 billion. However, it left a $35 billion cap on mortgage-backed securities unchanged, a level it has rarely hit since starting the process. So we need to understand what quantitative easing and quantitative tightening means. And it says here, in the most basic terms, QE and QT are opposite actions. QE refers to, or quantitative easing, refers to the Fed buying assets to lower longer-term interest rates, and QT means the Fed is selling assets to put upward pressure on long-term rates. QE is used when the Fed wants to stimulate the economy and reduce interest rates on longer-term securities. The Fed accomplishes this by purchasing large quantities of Treasury and mortgage-backed securities. Because such purchases can reduce longer-term interest rates and increase liquidity in financial markets, it helps provide economic stimulus. Historically, the Fed has used QE when short-term interest rates are near zero and additional monetary stimulus is needed, such as during a financial crisis or recession. Most recently, the Fed employed QE during the COVID-19 pandemic and grew its securities portfolio from a little under $4 trillion in March 2020 to $8.5 trillion by March 2022. Conversely, QT, or qualitative tightening, which is what they've been doing since 22 to get control of inflation, is used to cool the economy by allowing assets to mature off the central bank's balance sheet or by selling them. Diminishing the Fed's portfolio of longer-term debt leads to higher longer-term interest rates than would otherwise be the case, which reduces domestic investment and consumer spending on housing and durable goods. The Fed began implementing QT in the middle of 2022 in an effort to restrain economic activity and tame inflation. Such actions are currently reducing the balance sheet by about $60 billion per month. So, as we just read, the Federal Reserve is scaling back quantitative tightening. So, not quite stimulating the economy, but loosening the restrictions on the economy. And as this guy explains, quote, the Fed indirectly cut rates today by taking action to reduce the pace of runoff of its Treasury holdings. Jamie Cox, managing partner for Harris Financial Group, said, the Fed has multiple things to consider in the balance of risks, and this move was one of the easiest choices. This paves the way for the Fed to eliminate runoff by summer and with any luck, inflation data will be in place where reducing the federal funds rate will be the obvious choice. So cutting interest rates will be the obvious choice. So they're not yet injecting money into the financial market to boost the economy, but they're slowing the rate at which they're taking money out of the financial markets. And this creates demands for bonds, which means that the bond prices go up, which therefore means that the yields or the interest rates go down, which then means that mortgage rates could go down. And that's because mortgage rates are so heavily influenced by the 10-year treasury yield, and lenders use the 10-year treasury yield almost as a guide. And there's typically like a 1.5 to 2% spread between the two. So to sum it up, I think that these are early signs that the Federal Reserve is seeing the economy get to a better place, which would lead to more rate cuts, which the financial markets want. And that would likely lead to lower mortgage rates and business loans, and therefore more money left for, people to buy things that our companies sell. And that would lead to the housing market hopefully moving again. And it may make sense to buy a house and move and renovate and buy furniture and all of that stuff. So that's the whole domino effect of interest rates and why it's super important for the short term to pay attention to what the Federal Reserve is doing with them. And the last thing I want to touch on regarding this whole inflation situation is this: trueflation. And trueflation uses, real-time data like online prices, real estate listings, and other like more live economic indicators. So it can provide a more up-to-date view on inflation. And this is different from what the Federal Reserve uses, the CPI report or the Consumer Price Index, which we covered, I think, last week or the week before that. But the CPI relies on data collected by the Bureau of Labor Statistics through, surveys and like field data. But that process is slower, and the data often reflects, conditions weeks or months behind. So essentially, this right here, trueflation, can sometimes act as an early indicator of what the Fed might do, assuming that CPI eventually aligns with, these trueflation trends. But as you can see, in the last month, inflation, according to trueflation, has fallen well below the 2% inflation target that the Fed is aiming for. So we'll have to wait and see if CPI follows, and then we could potentially see rate cuts. Okay, moving on. On Thursday, we had Nike report earnings. And as you can see here on the right, they beat revenue by 2.3% roughly, and earnings by almost 80%. However, the stock was down almost 9% early this morning. So if you're new to the market, it can be kind of confusing to see companies, beat earnings but still take a hit. But what you have to do is actually dive into the numbers and look at the actual results. And the results were pretty horrible, but they were just not as horrible as analysts expected. So if we take a quick look at the numbers here, it says third quarter revenues were $11.3 billion, down 9%. Nike direct revenues were $4.7 billion, down 12%. Wholesale revenues were $6.2 billion, down 7%. So even though they beat their expectations, this is still a company that's seeing their revenues decline, which is something that investors never want to see. So what am I doing with my shares? So I currently own about 50 shares of Nike. It's about 5% of my portfolio. And I'm currently down almost 20% on these shares. This is, I think, my biggest losing position so far. But essentially, I could start buying more Nike here soon. We have to remember that these results weren't unexpected, and this is a company that's currently turning around. And we knew that it was going to take longer than, 1 or 2 quarters for the new CEO to come in and get this company on the right track again. And he is doing that by coming in and cleaning up after the previous CEO, who, as it turns out, mismanaged the company. He started focusing on these direct-to-consumer sales channels and even started, offering discounts through those channels. So on the Nike app and in the stores, they started offering discounts, which arguably, hurt Nike's brand. It didn't feel as premium as it was. And I honestly noticed that myself. The Nike app, there were constant discounts. So I just found myself waiting for the next round of discounts. So I was never going to buy a product full price. But what that also did was piss off the wholesalers, because you're undercutting them and competing with them. So they're just going to buy less product from you, and you're going to get worse product placement in their stores. So that has been one of the big focuses of Elliott Hill after he came in October or whenever it was of last year as CEO. really rebuilding the relationship with the retailers. And the earnings report also highlighted this. The progress we made against the Win Now strategic priorities we committed to 90 days ago reinforces my confidence that we are on the right path, said Elliott Hill, president and CEO. So this will take time, and they're doing stuff like clearing out existing inventory by doing this last wave of discounts. And by the way, if you're wanting Nike products, now is probably the time to go to the factory stores and get them. I bet they have some some great discounts going on right now. But yeah, they're also doing stuff like improving their product mix and focusing on marketing and innovation and like newness in their products with new models and colors and materials. But essentially, they're resetting the company, getting all the bad news out there, which has led to multiple firms actually downgrading the company. So we're almost reaching maximum negativity around the company at this point. But remember that the stock market is very forward looking and that stocks usually bottom on extreme negativity and, start going up at that point. So as the next quarter comes around, or maybe the quarter after that, and we start hearing positive news again, don't be surprised if the stock, moves up again, despite, still being in bad times with bad numbers. So just to touch on how I view this position, I got into the company pretty recently after it started trading at the same prices that it was trading at 5 years ago. So a lot of the risk has honestly been taken out of the stock at this point. And Elliott Hill, the new CEO, is a guy who has worked at Nike for like 32 years or something. So if someone understands what the company needs, it's going to be him. And I'm willing to hold on to my shares and probably add more in the next few weeks and hope that the turnaround is successful. And the reason I believe in this company is things like this. So, first of all, how long has the company been around? Like how many decades? A very long time. And how many competitors have they fought off in that time? A lot. So this says Nike remains a top brand for teens, but shows signs of wavering interest. So they're still a top brand. And this article goes on to say that continuing its influence among teenage consumers, 59% of the 6,020 teenage respondents said that Nike was their favorite footwear brand. 34% of survey respondents also named Nike as their top clothing brand. Also, side note here, this survey also found that a third, 38% of survey respondents named e.l.f. Cosmetics, another company that I own, as their top cosmetics brand. But I bring up these points because of the long-term trends. Nike has been a top brand for decades now. It still is. And if they're capturing, this many teenage consumers at this point, what do you think they're going to continue to wear as they grow up? What do you think they're going to make their kids wear when they grow up? Also, I don't know if you've been to any of those Nike factory stores, like at outlet malls recently, or at any point really, but they're always packed. So the demand is still there. People still love their Nike products. And going to those factory stores is honestly a nightmare. It's absolutely packed in there. You can barely get to anything. Then when you're going to check out, there's already like 25 people in line. So you end up just giving up on the whole thing. But it does convince me that people still love Nike and the company isn't going anywhere. And on top of this, with the company declining so much in their stock price, the dividend yield is honestly looking pretty nice at 2.3%. And that's, with a pretty healthy payout ratio of 47%. If a company's getting to 70, 80, 90% payout ratio, then I would be worried about them cutting the dividend. But we're not seeing that with Nike right now. So I could potentially start collecting dividends every single year. And if we take a look at the dividend chart down here somewhere, they consistently raise their dividends by, 8% a year. Every single year it goes up. And it'll likely continue to do that in the future. So moving on, we got the news that Celsius rises 43% after naming Eric Hansen as president and COO. The article goes on to say that Celsius Holdings, after announcing the appointment of Eric Hansen as president and COO, experienced a notable 42% increase in its stock price over the last month. Hansen's extensive experience in the beverage industry, particularly his tenure at PepsiCo, likely instilled confidence in investors about potential leadership strengthening in the functional beverages category. So as I said, this is exciting for the company because you have this extremely experienced person coming in as president from Pepsi. So I think he's going to be able to do a great job in guiding this company and, putting his experience to use. And Celsius is a company that we were, down almost 20% on not too long ago, like middle of February. And now we're currently up 26%. So after we just talked about Nike, this just shows how quickly things can turn around. And if we look at a 1 week chart here, just in the past week, the stock is up more than 22%. I'm not going to talk too much about Celsius here, but Celsius is this amazing company that has been showing, incredible 30 to 40% revenue growth numbers. And those revenue growth rates were largely over exaggerated from Pepsi over ordering inventory. And then they didn't need more inventory, so those growth rates started shrinking again. And that's why this company saw this 60, 70% drop in the past year. But the bottom line with this company is, sure, the growth rates might not have been as great, but now it's been traded down to, again, a valuation that's just ridiculous. All the risk has been taken out of the company. People still love the products, and they're going to return to growth. And now with this Pepsi guy on the team, it's just going to be better. Lastly, we have the news that Sofi is up 10% as it seals $5 billion deal with Blue Owl Capital. The article goes on to say that Sofi Technologies saw a notable price movement, with its stock increasing by 10% over the past week, which coincides with the finalization of an agreement for a $5 billion loan platform business with Blue Owl Capital. This agreement represents the company's largest loan platform business deal to date, highlighting an expansion in its personal loan offerings and a move towards less capital-intensive, fee-based income streams, which is exactly what the management team was talking about on their last earnings call. And a $5 billion deal for a company that, is currently making like generating $700 million in revenue a year is a huge deal. Okay, lastly, what did I buy this week? So if we look at my history here, and by the way, here's that $20 dividend from Nike. It starts pretty small, $20 for the quarter, but let's see what this dividend is in 5 years when they've been raising their dividend and I have continued to build out this position. But anyway, I bought 7 shares of Cheesecake Factory at $48.65. And I bought 1 more share of Amazon at $195 roughly. So you might ask, why not buy Nike? I mean, we just talked about Nike, and my opinion is that, the company's going to get on a better path moving forward. So I expect the stock price to go up. But, with the recent dip that we've seen in the overall market, I'm just more worried about missing, these prices for Cheesecake Factory, which has massive growth coming with North Italia, that whole franchise, and Flower Child. They have huge expansions coming in the US over the next decade or so. And Amazon too, if we look here, this is the cheapest valuation Amazon has traded at in many, many, many years. And, when I look at my portfolio, I see a lot of higher risk positions. So I decided to add to Amazon, which I expect to hold for decades to come, because the company has decades of growth ahead. And it's an indestructible company. It just grows revenues. All of their business segments are growing very nicely. So that's the reason there. If we look at Cake, they're still sitting at a ridiculously low valuation. And I'm more worried about missing the boat with this one than Nike. So I'm trying to get my shares in now before, people start seeing the growth with Flower Child that's coming in the next couple years. So I would essentially rather buy these companies right now, and then in the next few weeks, let's say the market recovers, Nike might still be in this bad news cycle, so I can pick up shares then. So that's it for news and updates for this week. Let me know what stocks you're buying this week or, this month during this market dip. Tell me why you're buying them in the comments below. But that'll be it for this video. See you in the next one.